Hello everybody, I am Vaishnavi and welcome to aliceblue Online. In this video, we are going to learn all about the liquidity in the stock market. Suppose you're planning to buy a refrigerator. You go to a nearby electronic shop, find one that suits you, purchase it by paying the price of the refrigerator in cash and move on. You see how easy it is? This is because cash is the most liquid financial asset. But what is liquidity? Keep watching to find out what is liquidity in the stock market, its types, and how to identify liquid stocks. Firstly, what is liquidity? Liquidity is a term used to describe the ability to buy or sell an asset quickly and efficiently without affecting the market price. The more liquid an asset is, the easier it is to buy and sell it. Now, let us find out what is market liquidity. Market liquidity is a parameter based on which you can determine how efficiently an asset can be bought and sold in the market at stable prices. A market is said to be more liquid when buyers and sellers trade easily at market prices. Buying and selling take place when there is enough demand and supply of assets in the market. On the other hand, the market is said to be less liquid if the number of sellers is more than the number of buyers and vice versa. Due to such scenarios, sellers may suffer losses as they can't sell their shares whenever they want to. The seller might have to compromise by selling it at a lesser rate than expected. Now let's understand why is liquidity important. In the stock market, high levels of liquidity will not only ensure adequate numbers of supply or demand in the market, but it also allows many trades to happen at one point in time. Now these are a few points that will make it easier for you to understand why liquidity is important. Liquidity enables investors to execute buy and sell orders at the desired price more efficiently. Liquidity helps increase the number of active participants in the stock market because you will easily find buyers to sell your assets. Liquidity also smoothens the transaction process. There are two main types of liquid assets. The types of liquidity assets are divided into two main categories: high liquidity assets and low liquidity assets. Under high liquidity assets, they consist of cash, cash equivalents, stocks, and exchange traded funds. Low liquidity assets are mutual funds, bonds, certificates of deposits. Let's get into each asset in detail. High liquidity assets. These are assets that can be immediately traded without affecting their market value. It consists of cash. Cash is considered the supreme liquid asset. It is an ever-friendly asset that can carry out any trade because it is highly accessible and acceptable in the market. The total amount of cash available to you equals the total amount of liquid assets you have. Not only in the form of physical currency, but you can also use cash through your bank accounts, UPI links, or other payment apps. Next is cash equivalents. As the name suggests, any asset that holds equal value as that of cash is known as cash equivalents. Bank accounts and marketable securities such as commercial paper and short-term government bonds are examples of cash equivalents. As cash and cash equivalents are the most liquid assets, they are always shown on the top line of a company's balance sheet. The next one is stocks. Stocks represent the shares of a company that can be easily traded on stock exchanges by people like you and me. If you own stocks in a company, you own a part of that company in proportion to the number of shares you own. Stocks are highly liquid assets and can easily be traded using a demat and trading account. In just a few simple, easy steps, you can create an account with aliceblue. If you are new to the concept of buying and selling stocks, then you must check out our video on how to buy shares online, for which the link is mentioned in the description box below. The next one is Exchange Traded Fund or ETF. ETFs are investment funds that are traded in real time on stock exchanges just like stocks do. This makes ETFs a liquid asset and hence you can buy and sell them with ease. ETFs contain all types of investment securities like stocks, commodities, currencies, and bonds. Examples of ETFs are Nippon India ETF Nifty BEES, HDFC Gold Exchange Traded Fund, etc. If you are planning to invest in ETFs, you can do it via aliceblue. You just have to open a demat account and start investing in ETFs. The price of ETFs keeps fluctuating throughout the day. They are bought and sold at any time on the stock market, thus making them highly liquid. Remember, not all ETFs are liquid. For example, bond ETFs. Now let's move on to low liquidity assets. These are assets with fewer trading opportunities in the market. They are difficult and time-consuming to buy and sell. First type is mutual funds. A mutual fund is a collection of securities including stocks, bonds, and short-term debt. They are managed by asset management firms. Mutual funds collect money from investors and use it to buy different types of securities. The value of a mutual fund is based on the type of securities it chooses to purchase. They are traded once a day, as a result of which their liquidity is relatively lower than the rest of the financial assets. Second is bonds. When you buy bonds, you are lending money to a company, the government, or any other organization. Many investors purchase bonds and hold them until they mature. This means that the bonds are relatively lesser liquid than stocks but provide investors with returns at regular intervals. Moving on to the third one, that is the certificates of deposits or CD. The objective of a CD is to put in writing that you have invested your money in a bank for a certain amount of time. The bank will then pay you interest on that money. Interest is paid based on the amount and duration of time you put your money in the bank. The certificate of deposit works as a saving instrument. As soon as the maturity period of your deposit is reached, the bank will pay your returns. Now let's understand how to identify liquid stocks. First, check if the trades you have planned for have the potential to execute quickly and efficiently. When you plan your trade, make sure you are benefited from the market trend. Next, make sure there is less difference between the bid and asking prices. Bid price is the buyer's price that they are willing to pay, and ask price is the price that the seller says they are willing to take. If the difference between them is small, the stock is more liquid. Let us find out what are illiquid assets. If an investor finds it difficult to sell an asset due to an inadequate number of buyers, it is said to be illiquid. They might have to face loss because during the time of need, investors might not find suitable buyers, as a result of which they have to settle with the price that is offered by the available buyers. Illiquid assets are considered highly risky because it is challenging to find a suitable buyer for such assets. It is recommended that investors and traders do adequate research to avoid trading illiquid assets. Illiquid assets have less market depth, lower trading volume, and lower market value. Examples of such assets could be private company interests, hedge funds, private equity, etc. According to Nifty 50, few high liquidity stocks in India are Idea, Freetail, ONGC, and Suzlon. Well, that was everything regarding liquidity in the stock market. Thank you so much for watching. For more such informative videos, make sure you subscribe to aliceblue online. This is Vaishnavi signing off. I will see you in the next video.
Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.